Chapter 6, Introduction to Alternative Assets, What Liquidity Really Means. Before we have that conversation, let's have a quick discussion on what liquidity is first. This chapter is probably the reason why this book may not be well received from the conventional financial media. In 2018, on a rainy January evening in San Francisco, I found myself at a social event at one of the most beautiful museums I have ever visited in the world. It was following the J.P. Morgan Healthcare Conference, hosted by a top international law firm, gathered in halls under the gold-plated banners displaying their benefactors' names beautifully etched in granite, using a font usually reserved by the Vatican to solemnize something. One of those names was Charles Schwab, the original merchant of liquidity. He was at the beginning of the equity market expansion into the middle class and the institutionalization soon after the Employee Retirement Income Security Act of 1974, or ERISA, was enacted. This was the advent of the modern-day 401k and the IRA and allowed for these new investors to buy stocks with their tax-deferred savings. A lot has changed since then. Decimalization, dark pools of liquidity, front-running, and other high-frequency trades have made only a few dozen people billions of dollars off of middle-class 401ks and IRAs. The middle class, therefore, only wins when the market goes up, never down or sideways. And there's very little they can do to control it. Because the middle class is conflicted by taking cues from the Oracle of Omaha, Warren Buffett himself, convincing people to stay invested while envying traders like Stephen Cohen, who are making billions of dollars a year by not holding for the long term and watching shows called Fast Money.